Okay, we just have a quick question from Draction asking us what is the pros and the cons of using the stock market to gauge the overall risk on and risk of sentiment. Now, the reason why equities, or let's call it the stock market, is such a good gauge of overall risk sentiment is due to a couple of factors. Firstly, equities are considered a high risk asset, especially when it's compared to something like a US government bond. Thus, they are very good, let's call it gauges of the overall mood of investors and whether there is appetite for risk in the market or not. Secondly, as short-term stock markets are very sensitive and basically driven by emotions, particularly greed and fear, risk on and risk off, it is one of the first places where a sudden change or a quick change in the sentiment can be observed as traders try and scramble to make sure that they are on the right side of that changing mood, from second to second. Thirdly, even though the underlying equities only trade or move during the exchange traded hours, we do have equity futures, like this example on investing.com. Where we have basically the Asian session, European session, and New York session equity futures. And that can give us a very quick snapshot of whether the global market sentiment is down or up at a very quick glance, which is useful info for us to have. However, there are obviously a couple of cons, like you said, that we need to keep in mind. Firstly, the market, let's call it the bigger market, is never moved just based on one thing. It's never just moved by equities. There are always multiple factors that can influence price moves across asset classes, which means equities might not always give us the right type of signal. For example, let's say the stock market has fallen over 10% yesterday due to a very strong risk-off tone in global markets. At some stage, it wouldn't be unreasonable to expect a pullback of that move to happen, whether that is the next session or the next day. Now, that pullback might not be due to a positive change in the risk tone. It might just be because of profit taking from that big move down. But at face value, if you look at your equity screen, you might be seeing equities as being all green across the board. And that can sometimes be a little bit confusing. But then also, we need to make sure that we're looking at other asset classes as well, like currencies, like commodities, like the bond markets, and basically understanding the reason for why we're seeing green across the board in equities, but not maybe the same effect in other markets as well. Another good example would be if equities, let's say, are all red across the board, but we don't see the same reaction in other asset classes. So equities are red, but we see commodities are trading up, high beta currencies are trading up, safe haven currencies are trading down, gold is trading down, just as an example. Now, that might be due to other individual factors that might be pushing equities lower, such as earnings disappointments. That in itself can obviously change the overall market sentiment, but it might not necessarily always have an impact on the rest of the market, transmission effects into currencies and commodities, etc. So in that sense, equity markets are very, very useful. It is something that we use on a daily basis, that we need to gauge on a daily basis. But they are just one cog which forms part of a much bigger market machine. And as fundamental traders, we need to use each asset class, whether that is equities, commodities, currencies, etc., in its appropriate setting and gauge the overall or the macro view to make a calculated decision based on the info that we have in front of us, whether the market is trading risk off or whether the market is trading risk on. So I hope that helps you out there, Traxon. If there's any other questions, please let us know.